Dear students, welcome to our MBA HHCM program, Financial Accounting. In this, today we are going to discuss about the balance sheet with the additional information. Now we have a caselet before us, that is, it's a case of Roosevelt Incorporated Company. Now let's have the details to be discussed. Now today we are going to talk about the balance sheet with adjustments, and this we will discuss with the help of a caselet on Roosevelt Company. Roosevelt commenced business with a capital of 2 lakhs on the first day of the month, and he bought plant and machinery for cash of 20,000, and he purchased furniture for 5,000, purchased goods from Srinidhi and purchased goods for 20,000. Roosevelt sold goods to Ankit for 60,000, and sales, cash sales 50,000, salary paid 5,000, rent to Rachita 4,000, commission received 10,000, wages 3,000, and with the help of this information we had to prepare the balance sheet. This is the information supplied to us, and we are going to prepare balance sheet with the help of this data. We know the rules of accounting, that all the business transactions are divided into 3 basic categories. We apply 3 rules to all the transactions. That is what we mean. There are transactions related to expenses and losses, incomes and gains, and there we apply a rule called nominal account rule. The rule for this account, the nominal account, is debit all expenses and losses, credit all incomes and gains. Meaning, under this rule, all expenses show debit balance, all losses show debit balance. Under this rule, all incomes show credit balance, all gains show credit balance. This is under nominal account. Let's say salaries, an expense account. It shows always debit balance. Rent, it's an expense account, always shows debit balance. Sales, it's an income account, always show credit balance. So, account related to expenses and losses, incomes and gains is nominal account. The rule is debit all expenses and losses, credit all incomes and gains. Let's come to the second category, the personal account. Persons are of 2 types. The artificial persons and legal persons, artificial or legal persons, and natural persons. Natural persons are created by God, like you and me, individuals. Artificial persons are created by the law of the land. And the rule for the transactions related to persons are, it is like this: debit the receiver, credit the giver. Roosevelt Private Limited, for example, is raising loan from Bank of Baroda. Bank of Baroda is a person created by the law of the land. Roosevelt also is created by the law of the land. So, 2 artificial persons are interacting. One person is raising loan, taking the benefit, and another person is giving the benefit. The benefit giver is credited with, the benefit receiver is debited with. Let's say salary paid to the employees. For the employee, he is an individual, natural person, and for us it's an expense. So the employee account is debited, in the form of salary it is paid, therefore we don't record as employee. So salary means salary paid to the employee. We write the item as salary and we debit it. So, for the employee, it is debited. Okay, for the company, it is credited. Okay, right. The salary account is debited, the cash account is credited, because company is paying the salary in the form of cash. Therefore, cash is credited, salary is debited. Salary belongs to the employee, cash belongs to the company or the employer. So, The rule for personal account, debit the receiver, credit the giver. And look at this, goods, Roosevelt sold goods to Ankit. Roosevelt is a company, artificial company. Ankit is a natural person. Roosevelt is an artificial person. So two persons, one is natural, another one is legal, or interacting. So there's one person giving, there's another person taking. Person giving is credited, the account giving is credited, the account taking is debited. Okay. So in light of this, let us look into some of the journal entries we have prepared. Okay. Look at this. These are the journal entries we have prepared. Okay. Now applying those three rules, we have prepared the journal entries, and these are the accounts we have prepared in the previous caselet. Now we have an additional information. Now the context here is, if we have the additional information other than what is being presented during the course of business in the year, or other than whatever is presented in the trial balance. For example, provide 20% depreciation on plant and machinery. Okay. Provide 10% depreciation on furniture. Right. Furniture sold for 1,000 rupees. Okay. During the year, company has taken a loan of 50,000 from State Bank of India. Fine. During the year, company has acquired the shares of Wipro for rupees 10,000. So these are the additional information items. So this additional information has to be incorporated. This additional information has to be incorporated. To incorporate, look at this first point, information. Provide 20% depreciation on plant and machinery. What is plant and machinery bought or existing in the company? Look at this. Here in the problem, Roosevelt purchased plant and machinery. Roosevelt purchased plant and machinery for cash for 20,000. So 20,000 is the worth of the asset, and depreciation provided is 20%. 20% into, how do you calculate? 20 by 100 into this 20,000 worth of the asset, and it comes to 4,000 rupees. That's the calculation working that we can give for depreciation on plant and machinery. Look at this. Yeah, the depreciation here is 4,000 on plant and machinery. Look at the 10% depreciation on furniture. Let's look at the furniture value in the caselet. Purchased furniture for rupees 5,000 rupees. 5,000. 5,000 is the worth, and 10% is the depreciation to be calculated. 10 by 100 into 5,000, 500 is the depreciation to be calculated on the furniture. Okay. Now two items we have completed. That is depreciation 20% on plant and machinery, 10% on furniture. Likewise, we have furniture sold for 1,000. Okay. Furniture sold for 1,000. Out of this 5,000 worth furniture that we have seen, 500 is the depreciated value, 1,000 is sold, 5,000 is the purchased amount. Out of that, 1,000 is sold, 4,000 left over. Okay. And on 5,000, we calculated depreciation already at 10%, which is 500. So 500 plus 1,000 is the deduction, and net amount is 3,500. Okay, this is also over. During the year, the company has taken a loan of 50,000 from SBI. SBI is an artificial person. Roosevelt also is an artificial person. One person is taken from another person. Okay. So 50,000 is received in the form of cash. So cash is coming. Cash is an asset. Cash is an asset. So assets related accounts are called real accounts. The rule for real accounts is debit whenever an asset comes in and credit whenever the asset goes out. So here cash is an asset, the liquid asset, the most liquid asset in the balance sheet is cash. Cash is coming in Therefore, debit what comes in is applied. And who is giving that cash? SBI is giving, and SBI account is credited. Now, as we know already, the first line is to be debited, the second line is to be credited. For example, when cash comes in, we write the journal entry as this. Okay, we write the journal entry as this. Look at this. Cash account debit to SBI loan account. The first line is always for the debit, the second line is always for the credit. So cash is coming in, debit what comes in 50,000 to SBI loan account, that is 50,000. Now look at the first, the previous items also. Depreciation account debited, keep it blank here. To plant and machinery 4,000, which we have calculated, 20% of 20,000, which is 4,000. To furniture 500, that is 10% of 5,000 is 500. So the total amount of 4,000 plus 500 is 4,500. You have to drop here. First you have to leave it blank, take the amounts from here, make a total of that, and the total you have to drop here. Depreciation account now debited 4,500, to plant and machinery 4,000, to furniture 500. Okay, so this is the first item here. Look at this. Provide 20% depreciation. We have accounted for it properly, right, by writing a journal entry here, right. Then likewise we sold the furniture. Okay, we sold the furniture. When we sell the furniture, cash comes into the company, and as per the real account, just as we discussed now, debit what comes in. Cash account debit 1,000 to furniture account, that is 1,000. The second line, when it is, when you are writing in the second line, it is implied that it is credited. Again, when it is written in the second line, leaving 2 letter space, you start writing the second row. That is a credited amount. That's a credited item. That's a credit transaction. Cash debit, furniture credit. Okay. Now this I have already discussed. Let's come to the next item. During the year, company acquired shares of Wipro for 10,000. When you acquire shares of Wipro, what happens is you have to pay to the company. In order to buy some asset, whether it is liquid asset or illiquid asset, you have to pay. So cash goes out, and what comes in? What comes in is plant and machinery. But are you paying cash? You're not paying cash. To him, you're issuing the debentures. So plant and machinery account debit 50,000, and instead of writing cash, had you paid cash, you'd have written cash here, but you're issuing him debentures to the worth of 50,000. So this is the end of the journal entry, and this is recording. We have a definition of accounting: recording, classifying, analyzing, summarizing. Okay, we just recorded it, and we will open the accounts for the same. Look at this. Earlier simple accounts you have written. Okay, now the revised accounts after the adjustments. Your cash account gets changed. Okay, and your plant and machinery account gets changed, furniture account gets changed, all these accounts are changed. Okay, let's look at that. Initially, when you look at the plant and machinery account, okay, there's an opening balance of 20,000. So plant and machinery account debit to balance brought down, that is 20,000. And you have also issued debentures and procured. Plant and machinery came in. Okay, in exchange of debentures, plant and machinery account debit to debentures 50,000. Total worth of assets are now 70,000. When the depreciation also is considered, 4,000 is the depreciation calculated on plant and machinery, and the leftover item worth of the assets is 66,000 out of 70,000. Look at this, 20 already opening balance, new asset bought 50,000, total worth of assets is 70,000, and both the sides you are writing 70,000. Okay, and depreciation calculated is 4,000 already on this 20%, not on this 50,000, because this is bought at a later stage. Had it been 6 months before or 3 months before or in the beginning of the year, you would have calculated depreciation on 70,000, but now you are not doing that. You are calculating only on 20,000, which is 4,000. 20% of 20,000, 4,000. Look at this. Our rule is drop both the amount, the same amount on both the sides. When you deduct the 4,000, the balance carried down, the difference, the balancing figure is 66,000. That is carried down balance. That's a net worth of the plant and machinery. Likewise, go to the next, furniture. The balance brought down is 5,000 and you have calculated depreciation of 10% on this 5,000. It is 500. Okay. Then you also sold the furniture worth 1,000. Okay. 500 is deterioration in the value of asset. 1,000 worth asset is sold. Okay. Out of this 5,000, look at this, 5,000 is the total on the debit side and you drop the same on the credit side also. After 500 and this 1,000, leftover amount is 3,500. That is the difference of balancing figure or carried down balance. This is called, this is a net value. Okay, this is the written down value is what called in accounting, 3,500. Okay. Then comes the depreciation account. How many assets are there? There are 2 assets, plant and machinery and furniture. Only on this depreciation is calculated, not on the debentures. There is no depreciation calculated, though debentures debentures is a liability and Wipro shares are also assets, but we don't calculate depreciation on that. But we calculate depreciation on the plant and machinery and furniture and fixtures. Why? Because these are depreciable assets. The value of these assets get deteriorated with the passage of the time due to wear and tear. Therefore, we have taken only these two types of assets. We have not considered the other types of assets. Financial assets we are not considering. So 4,000 is the first asset and 5,000 is the second asset. The total amount is 4,500 and nothing on the credit side. The total balance carried down is 4,500 and that's a total worth of depreciation for the year. Okay. Now depreciation also is over. Now we have SBI loan account. Okay. By cash 50,000 and to balance carried down. This is the closing balance. I'm just speeding it up. Okay. And the investment account, it is reverse. When you have taken by cash 50,000, whenever you are taking loan account is credited, cash account is debited. Okay. Investment, when it is investment account, okay, cash account is debited and the asset account is investment is an asset, it is debited. Okay. So with the cash, right, cash is going out, therefore it is credited. And likewise debenture account, debenture is a liability and it is credited. All liabilities accounts are credited. So this is all about the ledger accounts. Now our revised trial balance is this. Okay. Yeah, this cash account also gets changed. You know, earlier when you prepared the cash account, it was 2,03,000, but because you bought something, because you sold something, whenever you are selling goods, cash goes out. Whenever you're selling goods, cash comes in. Whenever you are buying goods, cash goes out. Once again, I am saying, whenever you are selling something, cash comes in, and whenever you are purchasing some asset, cash goes out. So due to that, your cash balance is 2,44,000, unlike 2,03,000 in your previous caselet. Now capital is 2 lakhs remaining. Okay, this is an asset account debited. This is a liability account credited. Plant and machinery also is 66,000 debited. Okay, furniture is an asset debited, it shows debit balance. Purchase is an expense. Okay, expense account always show debit balance 50,000. Then sales is an income, income accounts always show credit balance. And Srinidhi is a creditor, creditors always show, or liabilities always show, accounts always show credit balance 30,000. And Ankit is a debtor, debtors, okay, debtors always show debit balance 60,000. Salary is an expense, okay, debtors are assets also, therefore it is debited. Salary is an expense and all expense accounts are debited, shown debit balance. Rent is an expense, all expense accounts show debit balance. Commission is again gain. Okay, all incomes and gains always show credit balance. Wage is expense gain, all expenses account always show debit balance 3,000. SBI loan or liability, okay, always shows credit balance, therefore it is credited. Investment account always, it's an asset account always show debit balance, therefore it is written in the debit column. Debenture is a liability, all liabilities always show credit balance, therefore it is written in the credit column of the trial balance. Then depreciation is a loss, not an expense, it's a loss. Okay, all expenses and losses are shown in the debit column. Hence the trial balance total is 4,50,000 on both the sides. Okay, this is the total of the trial balance of Roosevelt. Now in this, your major task depends on how fast, how you segregate the total items of this trial balance into expenses and incomes, and losses and gains, and assets and liabilities. How best you can segregate, like a swan separating the milk from water, as our good old saying says, you should be able to separate the expenses from the losses, expenses from the incomes, expenses from the assets. Sometimes you get tempted to treat the expenses as assets as expenses in your accounting subject, and you should be able to clearly distinguish what is a liability, what is an income, what is an asset, what is an expense. Let us look at this. Let's have a glance at this trial balance and we start segregating it. Cash is an asset, clearly it is an asset. Capital, it is a liability for the company. You may be the owner of the company, but for the company it's a liability from its owner. Okay, and plant and machinery, clearly an asset, okay, therefore we indicated as an asset. And furniture, it's clearly an asset, A, we have indicated with A. Purchase, expense, we have indicated with E. And sales, it's an income, we indicated with I. Srinidhi, we indicated this with L because it's a liability, an obligation to meet. Ankit, it's an asset because we are supposed to receive money from our debtors. Then salary, it's an expense, therefore it is E, denoted with E. Rent, it's an expense, denoted with E. Commission, it's a gain, and we categorized into income, that's therefore we denoted with I. SBI loan, we denoted with L because it's a liability. Investment is an asset, okay, therefore we denoted with A. Debenture is a liability, we denoted with L. Depreciation denoted with E because it's an expense, or it's not an expense but we are putting it as expense for convenience sake. We have taken only 4 categories. Losses and gains we dropped in the incomes and expenses, okay. Therefore we got 4 categories: assets and liabilities, incomes and expenses. Now look at the profit and loss account here. Our profit and loss account, revised profit and loss account. How did I do this? All is all E's I have taken here. 1, 2, 3, 4, 5. All 5 expenses I brought and dropped here. 1, 50,000, 2, 5,000, 3, 4,000, 4, 3,000, 5, 4,500. All expenses and I copied and pasted here. From where? From the trial balance where I have marked. Then likewise we also have marked with I. How many I's? 1 I, 2 I's, I for income. There are 2 income items. Okay, there's 1 I of sales, another I of commission. That's a gain. So total is 1,20,000. 1,20,000 on both the sides. When you write, the difference between 1,20,000 and all expenses is 53,500, which is net profit transferred to the balance sheet. This will take in the balance sheet under the capital. Look at this. This is how we take. This is how we take. Look at the balance sheet. Yeah, the balance sheet has capital of 2 lakhs. Okay, how did you get? Where did you get? Yeah, all else 1. Okay, all else 2 and 3 and 4 also. So we brought all those 4 items. What are they? Capital, then Srinidhi, then we have SBI loan 4, and lastly debentures. All these we brought and dropped here. Okay, all 4 items we dropped here, and we also have added 53,500. There are 4 items here, and with the profit and loss account which we brought from profit and loss account, the net profit transferred, we are adding here to the net profit. Therefore, it became 5 items. Now let's look at the other items. Last item, last category of items. Asset, number 1, that is cash. Number 2, asset plant and machinery. Number 3, asset furniture. Number 4, asset Ankit. Okay. Number 5, asset investment. All these items we dropped, we bring and drop here. Plant and machinery of 66,000, 3,500 of investment, and 3,500 of furniture, investment of 10,000, 60,000 Ankit, and cash of 2,44,000. The total comes to 3,83,500 on both the sides. Balance sheet tallied. If balance sheet is not tallied, you have done something wrong. In our case, balance sheet is tallied, and this is the balance sheet. How to prepare the balance sheet with additional information or adjustments. Thank you.